All right, good afternoon, everyone. Let's first do a quick audio video slide check here. If you can see the slide, if you can see us here, just type a Y in the question box. Just let us know that all that is working. Okay, John says it's good. All right, Tina, yes. James, all right, great. All right, perfect. All right, so welcome everyone to this presentation hosted by FFR Trading. My name is John Madison. I'm the VP of Marketing here at FFR Trading. I'll be your host for this special presentation with Keith Harwood called Options Mastery Phase 1, Unveiling the Secrets of Pro Trading. You should see in just a moment the risk disclosure here. You're all aware that trading and investing involves risk, right? That's why FFR exists, because most people fail trying to do this themselves. And that is why we pair you up with proven traders like Keith Harwood, who have proven track records, and diversify you among different traders and strategies to help mitigate that risk. First, let's talk about who we are here at FFR Trading and what is our role here. So we are a boutique vetting firm. We vet all the traders that we work with, right? That includes putting them through what we call our 8-step certification process. That includes getting their brokerage statements, so you know as a subscriber, you are dealing with a veteran trader that has been thoroughly researched by us. Keith is one of those traders that we've partnered with. We handle the introductions between the traders and their subscribers because, as you can imagine, most actual traders don't have the time or skills to do their own marketing. That's where FFR comes in. We handle that for the traders, including the customer service. So at the end of the day, you know you're dealing with a tried and true veteran trader and service. So let's get into and talk to Keith. So Keith, I'm gonna bring you in here. And, going over your background, Keith, we work with a lot of traders, and we've got some great traders here at FFR Trader that we partnered with. But when we were going through your educational and your work experience background, man, you hit everything. I mean, you start at the CBOE in the pits, at the Chicago Board of Options. You're a market maker, you're a proprietary trader, you become a hedge fund trader. I mean, you've run the whole gamut on the institutional side. So just talk about, if you would, your background and share anything that you feel is important about that and what folks out there should know about you.
Thank you. Thanks. Yeah, no, got stuck muted. Yeah, no, I appreciate the introduction here. Yeah, so just to give the background, and actually there's part on here that's not there, but I went to the University of Notre Dame for undergraduate, and I was a math major. So I came from a less traditional background, I think, for traders, except back in 2005 when I started. That was becoming the popular. Now a lot of it is PhDs in physics because it's all about programming, but there was a switch from the guys that could just bully their way through the pit and get on all the flow to the people that really thought about it, did the math, found out the right way to trade the best potential value. I really enjoyed being a market maker on the CBOE floor. I mean, I went through the subprime crisis on the CBOE floor, so it's a very, very intense time in the markets. Of course, we saw a massive crash driven by financials. And I mean, frankly, I still remember one of my favorite trades that I couldn't have possibly thought of myself was there was this guy who's a genius backgammon player, and he was losing money, and he was worried that Goldman Sachs was going to go under. And so what he did is he walked into the other pit where Goldman Sachs options were traded and said, Goldman Sachs $5 puts, I'll sell 10,000 at 60 cents. So that's a $600,000 collection for him. And he's like, I'm going to take the next month off. If Goldman goes under, my account goes to zero, which is my goal, because if Goldman goes under, I don't want them using my account to finance their debts. So he financed his own account with this. Goldman didn't go under. He made $600,000 in a matter of about a week. I mean, things like that just in the pit were really enlightening to me. I mean, the same guy, though, he had a little bit of an attitude and a little bit of a temper. On a bad day, he broke 2 or 3 phones in the pit. So, you've got a different experience where you've got people breaking phones, coming up with really unique trade ideas. It was really enlightening to me. But then after we got through the subprime crisis, markets got really tight. As you see now, if you've been trading options, if you're looking at like SPY or QQQ, a lot of those options are a penny or 2 cents wide. It's not a huge edge for the market maker unless they're trading on volume or with a bias. I didn't want to trade on volume, so I learned how to trade with a bias. I moved on to another firm, started trading European fixed income and actually gold and silver futures options, trading with a bias in that during QE was a very interesting trading time because, of course, pumping all that money into the financial system put gold and silver really at sort of the forefront of everybody's mind. And at the same time, I kind of recognized that my ultimate goal was to get a fully well-rounded background. So I went and got my MBA from the University of Chicago in analytic finance, entrepreneurship, and econometrics. So, mostly mathematical type stuff again, but I added the entrepreneurship because ultimately my thought was if I can get through this with a full background with technical trading, options trading, directional trading, everything else that I need, then I can go back and start working with people to make sure that they trade a little bit smarter. I saw a lot of times people basically throughout my career as a market maker and proprietary trader and hedge fund trader, people always complained when the trade was against Goldman Sachs or against, Merrill Lynch or against one of these other professionals. But what they loved was trading against Ameritrade. Well, that's not really great for the people involved here. I would rather that not have such an edge to those traders where they're paying for that order flow in order to make sure that they can make that trade. So they will pay money to the exchange just to get the money flow from, a Charles Schwab account. That tells you just how much right now the retail trader versus the institutional trader was basically underappreciated and and I mean, maybe deservedly so, because the Goldman Sachs trader, he probably knows stuff that we don't know. But no, so after I was working with the hedge fund for a few years and learned a lot about technical trading, and actually I taught them a lot about options trading. They weren't big on options when I first joined. We had a nice trade-off of basically that knowledge where I could learn technical trading from them and they could learn options trading from me. I decided it was time to move on. I joined Option Hotline and I started into this career path of saying I want to teach people how to trade smarter, and I want to do it the right way. So, we've been working on trading signal programs. I've written a book we'll talk about later. I've got all this different various market sector experience, and then knew that once I hit that 15-year mark, I really basically had that point where now my knowledge is, I guess, well-rounded enough in order to really start to pass this along. It takes a long time to learn this. Just to give you an example, when I first started with my first market making firm, it took 1 whole year of training before they would let me trade money. And it wasn't a lot of money when they first started letting me trade. So if these professionals felt that it took a year of people that they felt were qualified of education, then I knew that that meant that there was a lot here to pass along. And if I could help people that were, maybe somewhat experienced or even inexperienced, that would be a great way for me to change my career from trying to help billionaires become multi-billionaires and try to help people from losing their account because of mistakes that are made early on in a career. I was talking to somebody today and they were explaining that options accounts tend to be significantly shorter lived than equity accounts because people think they understand it, but they miss something crucial, whether it's selling puts naked, taking too much margin, putting too much money into long options. People tend to lose a options account quicker than they lose an equity account because they are leveraged contracts. And even though the risk is defined, it's a lot of risk management problems. And that's something that I don't like seeing happen. I don't want people to lose money off of risk management issues. So I really like the idea of helping people do better in that aspect. So
one of the things I wanted to ask you, it kind of leads into what I wanted to ask you. You know, we talked about all the due diligence that we did on you,
yeah,
and you know, it's pretty extensive, probably than anybody else that you've dealt with.
absolutely.
One of the things I was curious about, and people may want to know, is why did you choose FFR? You know what, we know why we chose you. Obviously, we just talked about your background and in depth here. But why did you choose FFR? What was the reasoning behind that?
Yeah, so FFR, it seemed like, and it seems very clear to me, the due diligence that you guys do matches and aligns with my optimal sort of setup here. I mean, I want people that are looking to make sure that the educational content that they're providing is high quality and not just some dude that's going to last for a year and then blow out a bunch of people's accounts. That's not good for anybody. It puts a bad rap on this industry if that happens, and that's not anybody's goal. Knowing that you guys do such good due diligence, knowing that you guys have the same goals as I do and kind of are aligned there, it just makes a lot of sense to me to work with FFR on helping pair individuals with the right trader. If I'm not the right trader for you to help you get to the next step, FFR is not going to push me on you. They're not going to say you have to sign up with Keith anyway, just because that's who you guys have signed up. You know, it's finding the right guy or right woman for the right trader, the right client, and helping them get to that next stage. And I think that's crucial for what we're trying to do. We're both trying to make people better, not just trying to make a quick buck. So.
And we'll get into that too, and much appreciated. We'll get into that too, as we do always want to speak to potential clients first to make sure this is a good fit, and we'll talk about that in just a moment here. But I'm going to go through some of the details of the course, and then we'll get ready to switch over to you. So I know you're going to cover a lot more of the details, but just kind of kick things off. Guys, if you're looking to get started, whether you're a beginner, if you've got some experience with options like Keith talked about, which is a surprise to me that more people are losing trading options than they are the underlying equity. So a lot of people think they know what they're doing, but they don't really know what they're doing. If you're looking to improve your options trading or simply looking to understand options better, this is the course for you. All right, Keith is going to give you an incredible amount of information over 6 weeks. So it's 2 one-hour sessions per week for 6 weeks, talking about how options work, how he as a professional trader looks at the options market when structuring trades. Everyone should know that the markets give immediate, constant feedback, right, in the form of profits and losses in your trading. Key's going to explain the risks that you're taking when entering the options market and how you can avoid the downfalls that often take down beginners like we were just talking about, as well as intermediate option traders. Some of the course content, week 1, just to give you an idea, right off the bat, you're starting with charting and technical analysis, right? It's kind of everybody's favorite, right? We want to look at the charts. We want to see what indicators is Keith using. How does he base his decisions and so on. You're going to learn all that right off the bat. Week 2, walk through relative value and introduction to option spreads. All right, so if you think this is just a beginning course, no, right? Week 2, you're already talking about option spreads. Week 3, spotting trends, consolidation, and recognizing trading opportunities, right? Different types of trades and trending markets versus a market that's kind of channeling in a range, right? Week 4, option strategy, option Greeks, and contract selection, right? Everybody's, the option Greeks are Greek to a lot of people, right? You're gonna get that in week 4. Week 5, how to enter an options trade and when to enter, and how long to stay in the trade and when to exit. Week 6, you're gonna start with risk management, position sizing, learning to hold your winners and cut your losses, right? That's a huge point that most people leave undone. Okay, so again, I'm just kind of going over some of the basics that this is going to go over. Keith is going to take you through a deeper dive, get into the charts, how he sets up those charts, the indicators he's using, and all that good stuff. So Keith, I'll get ready to hand over to you here.
Yep.
He's again got some great content for you here. And then when we come back from Keith's presentation, we'll have a Q&A session with Keith. So you guys, whatever questions you have for him, you can get those answered here. And then we'll go over everything that comes with the service, and I'll show you the amazing offer that we have for you today. So Keith, I'll switch over to you.
Perfect, thank you.
And you should get a little pop-up on your end.
Yes. All right. So I think you guys should be seeing my screen okay. It should say how and why technical signals work.
Looks good.
All right, so that's kind of our big thing for today, is talking about how and why technical signals work. Just like John did, I have to show my disclosures because my lawyer said I have to. But all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please read through the rest of these disclosures over the next moment, and then we'll get into the content itself. All right. So what are we going to discuss today? I want to talk to you guys and give you some educational content that is an overview of some of the stuff that we would be discussing in the course. So getting you guys started down that row, getting you guys some of the information that I tend to trade and tend to teach to traders. And as I mentioned, I mean, I've taught traders from brand new, right out of college, starting as a hopeful market maker, to hedge fund managers. So a lot of this stuff can apply to people of any level of trader, especially if it's a piece of information that's new to you. So we're going to talk about using moving averages to identify a trend, the MACD, which is one of the specific trend tools that I use, as well as the RSI, and then why I use options, and then what's going on in today's market. So it gives you a good broad overview of some of the technical signals, as well as just kind of an introduction to why I use options and where that can really help leverage your returns and define your risk, which is ultimately the goal of options trading. But you do also have to understand that option strategies can get much more complicated than what we're going to be talking about today. So it's a brief overview as an introduction, and I hope that it's all good information for you guys. So simple moving averages take the average closing price over recent periods. So let's say, for example, we're going to take the 10-day simple moving average. All I'm doing is taking the closing price over the last 10 days, which is 2 weeks, and dividing it by 10. Or sorry, I'm taking the total price and then dividing by 10. So it's the average price over the 10 days. Very simple. Average price over 20 days is about a month. 50 is about 2.5 months. 100 is kind of randomly 5-ish months. 200 is 9 to 10 months. What happens here is that people like round numbers. So even though the average trading month has 22 trading days, they kind of round down to 20, round up to 50, round up to 100, and then it kind of gets a little funky. But these are the numbers that people look at. So that's why those are the numbers that a lot of people look at. When everybody's looking at the same thing, that tends to make it work. So everybody's trading off of that same piece of information and building their trading thesis off of a certain piece of information. And everybody knows that everybody's using that piece of information. It does help make it work. That also means, though, that when you've got a proprietary set of numbers like I use, you can sometimes find a decent edge over the market, because I'm not following the crowd every time. I'm looking for early indications of what the crowd is going to do, and then trying to get in early or getting out early before it gets bad. So you want to find a way to generate your edge relative to the market, but you have to know what the market's pricing in. What trend traders tend to do is trade on a view that if the stock price is above their key moving average, they want to be long the stock, i.e. own it. And if the stock price is below their key moving average, they either want to be out or short the stock and bet on lower price. So if we're above the 10-day moving average, somebody might bet that we're going to go higher. And why that happens is because when you get above the 10-day moving average, it's an indication that over the last 2 weeks, buyers outweigh the sellers. There are more buyers than sellers, and that tells me that there's somebody or somebodies out there building long positions looking for momentum to continue. That can give me an edge on a directional basis. And if I can have an edge on a directional basis and an edge on an options basis, then I have a really good edge on the market overall. So just a simple graph of the moving averages that I always use, and this is what my normal chart looks like for everybody that's interested. The moving averages are here as the red, purple, green, yellow, and blue lines. So this is a current S&P market chart, well, as of this morning. The purple line is the 10-day moving average, so that's the shortest term. The green is the 20-day moving average, that's the second shortest term. Blue is the 50-day moving average, you can see that's about a middle term. Yellow is 100-day moving average, and then you've got the red 200-day moving average. A lot of people talk about trends really being held up by that 200-day moving average, and you can see why. Just this most recent drop in the S&P 500, there were 4 straight days of testing the 200-day moving average and never really going below it. The market doesn't want to go below. It wants to hold up above that because if it gets below, you can have liquidation. So there are people trying to support the market at the 200-day moving average, but there are also people trying to get below and force that liquidation. They didn't get it below this time. That's why we get a bounce back, but we didn't get much follow through. So when I look at these moving averages, I start to say to myself, okay, well, the moving averages are telling me that the market's not quite ready to break hard, but if we test the 200-day moving average again, we could. These are things that I'm analyzing every day in not just the S&P or NASDAQ or small caps, Russell 2000, I'm doing it in a lot of individual stocks as well, finding where people are providing what's called support, levels that the market just can't get below, or resistance levels the market just can't really seem to get above. And that's what we look at with moving averages is if you can't get below a key moving average, that's your support level. If you can't get above a key moving average, like the 50-day moving average has been pretty tough here recently, that's our resistance. And if we get through one of those numbers, it can change things really quickly. Now, at the same time, there are people that use a triple moving average. Now, this is a system that helps me to find who's in control even more. I can identify what a stock's momentum looks like by using a triple moving average system. And what I do is I compare, say, the 10, 20, and 50-day moving average, or another combination of these frequently used moving averages, as an early indication of a trend. When the shortest term is above the middle term and that's above the longest term, that's the bullish side. Vice versa, if the 10 is below the 20 and that's below the 50, that would be the bearish side of things. So people get nervous when short-term moving averages are below long-term, and they get bullish and excited on the other way around. So you've got multiple ways to trade these moving averages. You can either do short-term trades based upon quick moves above the 10-day moving average, for example, or you can wait for confirmation by waiting for the 10-day to get above the 20, to get above the 50. And in that process, all you've really done is gotten to a point where the market is really, really bullish and really excited about the potential for the next move. And you know that you've got momentum on many time frames. I use a proprietary set of numbers. I'll provide that in the upcoming course, as I mentioned. So if you sign up for the course, you'll get the numbers that I use that do better than the 10, the 20, and the 50. Just as a heads up, that's something that I will make sure that you guys get during the course, okay? Another moving average indicator is the MACD. So the MACD is a very interesting tool, and it uses exponential moving averages rather than simple moving averages. So instead of taking the average over the 10-day period, it puts more weight on more recent days. So yesterday's trading day will have a heavier weight than one from 2 weeks ago. All right, and that's the key there is saying that the more recent trades matter more. You can kind of replicate that with the simple moving averages by having shorter terms, but it's something that a lot of people like. And this MACD, generated by whoever did it years ago, the moving average convergence divergence, it uses exponential moving averages and compares a 26-day moving average to the 12-day exponential moving average, and subtracting the 26-day exponential moving average from the 12-day exponential moving average and comparing these to the 9-day exponential moving average. Honestly, the rationale between those numbers is probably because somebody back tested it and it worked the best, but that's the number, that's the standard. I just trust that for a MACD because I use this more as a signal for an end of a trend or something that's maybe changing a trend. There are three elements that trend traders tend to watch with the MACD signal, and that's either a crossover, a divergence, or a dramatic rise and fall. And I'm going to show you examples of a couple of those right now, okay? So back to this S&P chart, we did have a MACD crossover right when we hit the 200-day moving average. That's a really good indication that maybe this downward trend might be slowing or ending in the short term. All right, that's the crossover. When you see the black line cross the purple, when black goes above purple, it's anti-bearish. So it's not bullish, but it's anti-bearish. And then when you see black cross purple here, it's anti-bullish. And then you need another signal to generate that bearish signal in general. Sometimes people trade these on their own as a bullish signal and a bearish signal. I tend to find that it's more derivative, just given how many elements you have to do in order to get there. You have to do this exponential moving average in 3 different terms and then compare them together. It gets a little complicated to say that that's an outright signal that I would always trust on its own. Now, the divergence happens when you have an upward trending market, but the MACD is making lower highs and lower lows. Lower highs, not lower lows necessarily. Let me see if I can draw on here real quick. So what I'm looking for here is the fact that since here, we've basically been drifting downwards on the MACD highs, and yet we're still drifting higher in Google. So Google's stock has continued to go higher, and yet the MACDs have been making lower highs. Now we had a crossover here to show a little bit of bullish behavior. If this crosses back below, that could generate a really bearish signal for Google, and all of a sudden now that would be something that I would generate a potential trade entry on. The MACD versus an upward trend here in the markets, that generates some interest for me. All right, I got to switch back to pointer here. There we go. So those are generally some of the big moving average signals that I use. The other one that I wanted to talk about today was the RSI. Now, relative strength is calculated basically by comparing how much we go up on up days and how much we go down on down days. And the reason that this is an interesting calculation for people is that they say, well, some days you just have consolidation, and so you just don't have much of an up day, much of a down day. It's just a flat day. But if you're getting up days where people are buying aggressively and then down days where it's just a little profit taking, that can be a sign that there's somebody building a long position and just waiting for somebody to take off their long position so that they know they can buy more again. Generally like from a market maker, because the market makers, they're buying and selling all the time. And often when somebody's building a long position, the market maker is getting short. And then when somebody's taking profits and selling out their stock position, the market maker's buying back their position. For an RSI, we use 14 trading days of history to make this calculation. So it's just about 3 weeks. And it's relative strength is that key input to the RSI. So relative strength was the average moves here. And for relative strength index, it's 100 minus 100 divided by 1 plus the relative strength. Easier to visualize once you look at it on the chart. This is the RSI, this one right here. So you can see that we generally sit in the indices kind of in that range from 40 to 60. Going above 70 tends to give you an overbought signal. What an overbought signal means is that we've been having too aggressive of buyers and it's time to slow down a little bit. And that's what we saw here. And then again here, we slowed down. And then actually we had a big pullback, but getting down below 30 meant we were oversold and it was probably time to stop going down. And lo and behold, it kind of works. So it's a position management thing. It's not necessarily an indication that we're going to go down just because we're overbought, but it might mean that we either get a small pullback or some stagnation for a week or a month. That gives an opportunity to wait and see or trade a option strategy that profits off of consolidation. These are the opportunities that I'm always looking for in the markets. These are the opportunities that I want to teach you guys how to trade in the markets, because when you see an overbought RSI, barring some fundamental input that's causing it to really spike and gives it justification, you can often assume that we're going to either consolidate or pull back, and it gives you an opportunity to trade a strategy around that. And that's what systematic trading really does. So trend following trading systems tend to be more rules-based than other trades. So fundamental people, they're doing their analysis. They're spending hours digging through K1s and things, or 10Qs. Trend following systems are building off however many inputs they need from the technical basis and saying, these are the ones that I want to implement, and these are the ones that I want to trade based upon. And that's what we try to see when we're building a trend following system. You want to have defined rules for the whole trade. That way you eliminate the emotion of trading. You're basically acting almost as a computer, but with a little bit of a personal opinion at times. So for example, if you say that there's a stock that you just absolutely won't buy, that would be where you would do systematic trading without that. Or you can create a systematic trend following trade that you just wait for your computer to tell you it's time to get out and then exit. And generally speaking, that's the way I approach options, because options markets can sometimes get wide and you don't want to just send market orders. And sometimes options markets are just not pricing in what the move has been already. And so you might want to be changing the position. So to be a systematic trade, you need a defined rule for the entry and exit of the trade, and that's really comes through the equity side. It provides a setup that can then be back tested and implemented to the point of automation if it's an equity or a futures position, for example. A lot of Forex traders use trend following systematic trades. But keep in mind that incorporating the options tends to mean that there will be some discretion in the trade, so it's not truly systematic anymore. So as you go through that evaluation, you might incorporate the options analysis that we're going to talk about during the course in order to determine what kind of trade you're going to be. Because you're not always going to say, I want to buy at the money calls. Sometimes you'll want to buy an in the money call, or a call spread, or a call butterfly, or a call calendar. There are so many ways to trade a trend depending upon what the market's opportunity is giving you. And that's something that I think people often miss out on, is understanding that systematic trade can actually be traded better once you do an options analysis around it. So why do these trend following systems work? It's because they historically predicted price movement, and now people trust them. So trust is crucial in life, business, markets, everything. If something has been reliable in the past, it is expected to be reliable in the future. I think that we would all probably agree on that generally speaking, if you trust someone, you expect them to be reliable going forward. Otherwise, you will have some mistrust. Well, these systems have been working, so people trust them. And then they build systematic trades based upon the signals that have historically worked. But you have to be careful. The fact that many humans and computers follow the same signals, like those moving average numbers of the 10, the 20, and the 50, and the 100 and 200, if that signal fails, there's potential for major liquidation moves, and that actually sets up another type of trade. But there are systematic trades specifically designed to try to stop out those other systematic trades as a result. So you can always see that these can work really well, but then fail. That's a large part of why I use options, and the way I use options is also incorporated into that. For example, if I see a stock that's trending higher, I'm not just going to sell naked puts, because then if the system fails, and let's say we go below the key moving average, we could have a major liquidation to the downside, and a naked short put could liquidate my account. That's what gets people lost in the market, making the wrong type of options trade given the setup. That's why we lose those market opportunities sometimes, where people end up, losing their options account faster than they would lose an equity account. Now, keep in mind that options do have risks. there are higher transaction costs than stock trades. There's assignment risk. If you are selling options, you could be assigned. So let's say you sell a call option. If you get assigned, you're now short the stock. If you don't have that stock in your portfolio, you now might have a margin call and have to buy it back. So you always have to take into account some of these extra risks that are always there. Decay. If you're long options, they decay in value over time because they're effectively an insurance contract. If you're buying insurance and it expires in 30 days, it's going to have more value than if it expires in 10 days. Volatility is constantly changing in the marketplace. That's what I spent my years as a market maker doing, is changing the implied volatility multiple times per day in every stock I was trading. Might be trading 200 stocks, and I'm basically updating my personal expectation of implied volatility. It's, it's a busy job to sit there and do that for 200 stocks, but that's what you're constantly doing, is responding to market behaviors. There are other risks to consider. These are the key risk factors for me and what I tend to cover in terms of my trading philosophies. Now I'm just going to cover real quick why I use options, and then we'll get into the markets. So for those of you not familiar with options at all, this is going to be a little bit new. For those that have traded options before, some of it could be a little bit new in terms of the way that I explain it. So you should definitely still listen in. If I have a $100 stock and I think it's going to $120 in the next month, and my stop loss is if the stock goes below 90 bucks, then I'm looking at this sort of setup. My risk tolerance for $1,000 would be 100 shares, so I can buy 100 shares of stock for $1,000. If it goes to $120, I would make $2,000 minus commissions and fees. If it goes to $90, I would lose $1,000 in additional commissions and fees. But even though I have a max loss of $1,000 in mind, if something happens that goes really wrong with this stock, like, it has an earnings announcement, or it pre-announces earnings, or they have an accounting problem, it can go much lower, and we've seen it happen. So I may not be able to execute my stop loss at the price I think I should be able to. At the same point, I may not be able to execute my exit at the price I think I should be able to. The stock could get taken over, the next day for $150 a share, and I make a lot more upside than the original expectation of $2,000. But my bigger concern is not losing my account. I don't want to lose my account. I want to make sure that I'm still there for the next trade. And that's why people set these stop losses, but they don't always end up reliable. However, with a long call, you can set that stop loss because it's embedded into the price of the option. So a call gives you the right, but not the requirement, to buy the stock for that, for your strike price anytime before expiration. So if you're in that $100 call, then I have the right, but not the obligation, to buy the stock for $100 a share. And if my risk is $1,000, these calls are going to be cheaper because they have to give me control of more shares in order to be justifiable rather than a stock position. So maybe it's $5 per contract, which is $5 per share per contract, which means that each call would cost me $500. So if I'm buying 2 calls, that would cost me $1,000. Now I have unlimited upside. If I get to $120, I make I make $3,000. I make the $4,000 minus my initial $1,000 investment. And then on the downside, I just lose $1,000 no matter what. Now I do have to make more money in the stock. If it only goes up a little, I can still lose money because I'm paying $5 per share in premium. So I have to see the stock move to the upside to justify this kind of trade. Where you can see that is really the comparison here. If we have the stock go above $110 a share, it makes more sense for me to be long calls. If it goes below 90, it makes more sense for me to be long calls. But if it stays within $10 of the current price, between 90 and 110, then a stock position would have made more sense. There are other positions that you can put on here with like a call spread or a butterfly that would completely change the risk profile and utilize this optionality and define that risk. So there's a lot of ways to play this. This is just the simplest way right here. We'll cover a lot of the more complicated ways to play it in the course. All right. And then if there's only one thing that you take away from this, one thing and this is the thing that I've been kind of harping on, is let's not allow people to lose their entire account when they're just getting started. Just because you have a $10,000 account doesn't mean you put $10,000 into every trade. Why am I only willing to buy 2 calls in the scenario I came up with? Well, because I only want to risk $1,000. And yes, it caps my upside, but it means that if the stock doesn't move, I only lose $1,000 versus 100 shares of stock. If it goes down to $85 a share, I lose $1,500. If I do all 20 calls, put all $10,000 in, I lose my entire account. So I'm losing my entire account, basically anything under about $100, and I'm losing a lot of my account if it doesn't go up at least 5%. That's not correct risk management in general. Everybody has their own risk tolerance, so to each their own, but please be aware of the risk of options, knowing that they decay and that if they don't move, you can lose money. Now, finally, let's talk about the 3 major indices that I like to follow, and talk a little bit about what we're seeing in those technical signals today. I already covered the S&P. It seems like it's holding at the 200-day moving average. We had the MACD crossover. Maybe there's some upside here, but if we get back below the 20-day moving average, I expect a test of the 200-day moving average. So there's not a lot going on in the S&P 500. It's kind of middle of the road relative to tech. So tech never got to the 200-day moving average. It is also testing the 20-day moving average, but you can see how close we are to highs. Also had the MACD crossover, looks very bullish, relatively speaking. So if we have a bull market, I still kind of expect tech to lead, even though it's already been leading for 15 years. So moving averages can help predict this sort of movement, and they can change very quickly. Within 3 days, we might have a complete change of thought here, because if Apple drops, it can take down tech fast. And then finally, we have small caps, and small caps are really the underperformer. You can see that they're near lows, well below all the moving averages. We have a downward trend that really got established around September 18th-ish, when we first closed below the 200-day moving average, and then just continues to keep happening. The MACD crossover did happen, so that was that anti-bearish, but if we make a new low, you can see that we're probably going to get into a bearish trend again. And that's going to create a potential opportunity for an explosive downside move, because if we get below this low from May, all of a sudden, I don't know where the next buyer is. So I'm nervous about small caps. At the end of the day, if we end up bullish, this will just get dragged back up and everything will be fine. And S&P just seems like it wants to go in the middle. So you can see how quickly you can run through these MACDs and moving averages once you've had some time really studying them and understanding them, looking at the moving averages, looking at the MACDs, looking at the RSI here that's not oversold anymore. These are all indicators to me that IWM could have some downside, and that makes me nervous. Now, with all that in mind, options mastery 1, that's the course. John mentioned it before. You're going to learn market psychology, when to buy and sell options, learning how to use options verticals, condors, butterflies, straddles, strangles, trading skew, which would be using a tool like a risk reversal. There are so many different nuanced elements to options trading, and I'm going to try to cover as much of it as I can for you in those 12 one-hour courses, especially risk management and position sizing. So the risk management and position sizing is always the most crucial element, but all along the way, I want to make sure that you guys understand when I use each of these tools in my own personal trading. All right. And with that, I think we'll head back to John here. John?
All right, great stuff, Keith. Guys, we're going to go ahead and head into the Q&A portion here. So if you want to post your questions here, I'm going to switch back over here. And you should see my screen here. So Keith, what I'll do is I will read the questions off to you and you can field them. And let's see what we've got. First, Matt wants to know, will we get all the settings for your indicators to put on our charts during the course?
Yeah, absolutely. That'll be part of the early stages, of course, because I want to make sure that you guys have the same settings that I have. and that when you're looking at it, we're all looking at the same thing.
Okay, and then Tiffany wants to know what you mean by trading skew.
So skew is basically the volatility difference, implied volatility difference of the put options and the call options. So, in QQQ, it's trading around $360. There is a difference in the option implied volatility for the 300 puts and the $400 calls. The reason this tends to come up is because people traditionally are long stocks, and to hedge their positions, they look to buy puts. Well, that costs money. So to finance that hedge, they sell some calls and say, well, if the stock goes up by $40, or in this case a little over 10%, I'm okay being called away from my position. But if the stock goes down 20% unexpectedly, I need to make sure I'm out and I don't take a catastrophic loss. So investors tend to buy puts and sell calls, and that creates this skew in the market where the puts tend to have a higher volatility than the calls. And that's constantly changing, because sometimes you will have a spot where people think that the stock could get taken over and they're buying calls speculatively, and then all of a sudden you have a completely different skew relationship. So it's a complicated part of trading, but it's really important whenever you do relative value spreads, because relative value is going to be looking at skew or term risk, where you're looking at, say, two different expiration dates and saying which one makes more sense to be long or short.
Okay, perfect. And Maria, yes, the sessions will be recorded, correct, Keith? So people can,
Yes.
if they miss a session or if they want to go back and review. So all these sessions will be recorded. Leonard wants to know, does it matter what platform we use?
No, so that's a personal preference. I tend to do my analytics on a product that is provided by the CBOE called LiveVol. It does incur a monthly cost, but I like it because it creates some implied volatility analytics that are not available on every platform, but to each their own on how they want to do their analytics for stock charting and implied volatility and things of that nature. So a lot of free products out there will give you sufficient analytics, especially if you're trading on that platform.
Okay, great. And another question is, do you trade precious metals? What are your thoughts on trading them, and do you cover them in your course?
So I was not planning on covering the precious metals in the actual course. I do trade them still, just because I had the years of experience on it. It tends to be highly correlated to dollar movements right now, especially dollar yen, and that's really where I kind of generate my trading biases on the precious metals, looking at dollar yen and bonds and things of that nature. Just a lot of correlation type ways to trade them rather than trading off of their individual momentum.
All right, and Davis asks, how long do you hold your options?
So for what I call swing trade, which is like a shorter term momentum trade, can be anywhere from a couple of days to a month. Ideally, when I'm getting into a trend, I'm looking to hold the position overall for months, but I will often roll that position. And what rolling that position means is that I'm changing my expiration based upon the market conditions. So I mentioned that, sometimes with skew or term structure risk or any other changes in the market dynamics, I'm not necessarily feeling like I'm in the optimal position on, from Monday, it might have been great. And then the following Monday, it just seems like there's a better position. So I roll into a different position that gives me a better risk reward payout.
And as more questions come in, let me just ask you, Keith.
Yeah.
Why would somebody, or why should they sign up for this course?
Yeah. So, as I mentioned, I think the biggest thing that happens to a lot of people is they make early mistakes, and it really hurts an account. I had a guy I worked with who he dropped a $100,000 account down to $1,000, and that's almost not recoverable. But then he called me. He's like, hey, how can I try to figure this out? And I told him, I was like, well, we can work together on trying to figure some stuff out, but don't expect to get back to $100,000 by any means. And he somehow got back up to about $50,000 and then made a terrible mistake again and dropped it all the way to zero because he did something that I told him I would have never. Why would you do that? It was just not a smart idea. It didn't make sense given the current market conditions. And he was like, well, we did it once before and it worked. So, kind of learning what can be repeated versus what you need to just kind of do one time, or learning how to repeat the process, but applying the right options price at the same time. I mean, so basically he started just buying puts willy-nilly, saying the market's going to continue to collapse when the technical signals didn't give that answer. So he blew out an account that we had almost recovered, or at least had recovered quite a bit for him over the course of about a year. And that was not normal returns. He was sizing stuff worse than I told him. He was making a lot of mistakes on top of it in order to get his account back. But then, of course, because he was making those mistakes, he continued to make them and ended up finishing off the account at the end of the day. So, there's an opportunity to make sure that you don't make these mistakes that a lot of individual traders make. Like I said, in my first year of trading, I didn't get a lot of money as a CBOE market maker, even though I had already had about a year of training in the pits, because it just takes time to make sure that you understand the proper risk management, position sizing, and structure of all these trades you're doing.
All right, great. And Stephen wants to know, what is your win-loss rate?
So it depends upon the portfolio. When I do like a momentum trade, I probably make money on anywhere between 35 and 40% of my trades, but the whole goal with those is I take highly leveraged trades. So the size of the win is bigger, and thus the expected value is higher. And that's really the key for trading, is looking for the expected value, which combines both the win-loss and the win-loss ratio and the size of the win versus the size of the loss. Like on a technical trade, should be around 60, 65%, could be higher. If you're going for like selling options naked, you should be making money on 95% of your trades, because at some point you're going to blow out your account. If you need an example, look up long-term capital management. They basically had like a 99% win rate and went broke. So.
Yeah, unbelievable story that.
Yeah.
Let me pick up where we left off here. So the platform that you're going to be using, are you going to be using Zoom to teach the class? Is that correct?
Yeah, actually, I haven't determined yet. It would either be Zoom or GoToMeeting. So yeah, one of the two.
Okay. And that was just a question that Mark had. Let's see. Someone wants to know, is a $10,000 account enough money to trade options with?
Yeah, I mean, people certainly trade with $10,000 accounts all the time. Some people trade with a $100,000 account. Some people try to trade with like a $1,000 account. That can be difficult, but $10,000 is certainly a reasonable amount of money to trade with, as long as you don't have unreasonable expectations of making, 500% a year. If you have that kind of expectation or that kind of need, then it's not necessarily going to fit what you're looking for. So, but with $10,000, you can certainly trade. It's just a matter of understanding the expectations for your risk and reward over the course of the year.
All right, great. And Jason wants to know, are any of your indicators subscription based?
What do you mean? I guess.
In other words, are they like proprietary? Is it something they're going to have to pay on a monthly basis to get those indicators, or how does that work?
Yes, they're all sort of standard. It's just a matter of putting in the correct parameters, or my parameters, not necessarily correct. I guess I shouldn't be too confident on them, but sometimes they work better, and I found over the long haul that they do work better. So.
And let's see, Jonathan wants to know, how long do you typically hold on to a trade before closing?
Yeah, so as I mentioned before, like with the trend trading, I tend to try to be around 6 months, and then with the shorter term, like momentum trades, it's an average of probably about 3 weeks.
All right, and then the last one I'll pick up here, Leonard. What was the name, he says, of your platform again? I guess, Leonard, are you referring to the
Yeah, so
charting?
the analytics, the analytics tool that I use for volatility analysis is called LiveVol. It comes from the CBOE. They've been around for a while, and I actually knew the founders of LiveVol before it became a CBOE product. So I've always liked the product. It just does a decent job of giving me a lot of the analytics that I like to use.
All right, perfect. All right, so I'm gonna pick back up where we left off here. So great questions, guys. If you have further questions, Guy, we'll give you the number to call, or the email if you want to email them in, and we can help answer any questions that you have beyond what we covered here. This is what the course is going to look like. It doesn't matter if you're a beginner, if you're intermediate, right? You're going to help, what Keith is going to teach you is going to help level you up to the next level. It's a rules-based, time-tested, proven strategy for trading and investing. He's going to provide you with a systematic and diversified approach to building wealth. Let me turn my video on here so you guys can see me here. And he's going to impart a process for managing risk, which is huge, because what most traders lack is that process. So he's going to walk you through specific strategies for trading options using charts from a few minutes to a few days. He showed some of those to you today. Some of the highlights, what is an option and what is its purpose? A lot of people don't even know that. Buying and selling, buying versus selling options, directional trading. Again, talking about the Greeks, gamma, theta, vega, delta, what do they mean? How do we use those? All right, so the offer we've got for you guys, and Keith put a lot of effort into this, and we kind of twisted his arm on a few things to make sure that we could do the best for you here. Again, this is a 6-week course. It's 2 one-hour sessions per week for 6 weeks. The sessions will be recorded, so you can go back, you can review them, or if you miss a session, you won't really miss it because you'll have it on a recording. Now, we're giving you a 25% discount, right? So it's normally $39.97. We're cutting that to $29.97, all right? But we've thrown in some bonuses, and Keith, talk to me about, first bonus is, when you go through the course, right, you're going to have a lot of questions. The first bonus that we're throwing in is you're going to have a free 1-hour one-on-one training session with Keith, right? Because you imagine going through all that information, sometimes you might maybe you miss a session, or there was questions that you forgot to ask, or you're building a list of questions and you've gone through the material. Now you want to, get one-on-one with Keith and get some time to get those questions answered or get clarification on things. Is that pretty much what that'll look like, Keith?
Yeah, so a lot of times, like you said, people, they finish up a course like this, and 4 weeks later, they're like, gosh, I didn't understand this one thing as well as I thought I did, and it's time for me to go back and I can talk to Keith. Now, this is, something I do occasionally with individuals for mentoring type purposes. And, I think that it can be really valuable to making sure that you understand what you were hoping to learn from the course. If your main goal was to learn more about option verticals and you feel like you have follow-up questions, I want to make myself available to you to make sure that you got what you needed out of the course and really understand well what you were expecting to make or expecting to figure out. And I'm doing this as a one-on-one only, so it will not be with others. So if you have questions throughout the course and you just feel like you missed out on taking advantage of asking the question at the quote unquote right time, you can always ask me afterwards and we can sit down, walk through it, and make sure that you really understand exactly what you need to know.
All right, fantastic. Now, before you guys even start the course, all right, there's some pre-course education that Keith is going to give you, and that is his book, Think Like a Market Maker, Profit Like a Pro. This is going to take some time to get through, Keith, right? This is not, a few pages here we're talking about.
No,
This is a lot of information that you want to start them off before they even get to the weekly sessions, correct?
Yeah, absolutely. See if I have a copy of it in front of me. Don't seem to right now, but no, yeah, it's over 100 pages, of 8.5 by 11 pieces of paper. So we're not talking like a little handbook. This is, a serious amount of content, a serious amount of information. But taking advantage of that beforehand can really help set you up. Understanding some more of, if you're a brand new beginner, you can read through the section about what's a call, what's a put. You can start into verticals, you can start into trend trading as you want throughout the course, and really get through some of the content and just have this as a supplementary thing, because at the end of the day, having all that information can be invaluable to your learning experience, much like having a textbook.
And I forgot to mention, guys, this is limited. We're only taking 15 people. And the reason we're only taking 15 people is, you can imagine, having one-on-ones with each person, that takes a lot of time. So we have to limit the number of people that we can even bring into this course. For today only, all right, the next bonus for today only, if you're signing up today, you're going to get a 3 months of your big league options trade service. So this is a service where they're actually going to get trade alerts that they can act upon. And we're adding this because this is giving them an opportunity to earn while they're learning. So talk a little bit about your big league options service that you're offering them.
Yeah, so it is a trend following system built off of the NASDAQ 100. The idea is to find ways to earn while you learn, or potentially at least watch and see how a professional trader manages a trend trade. So you can see it in real time, as opposed to just seeing, examples and things like that we have to, when we're doing an educational course, we have to take examples that have already kind of gone through the course. You can see something in real time here, and you get real-time entry alerts, real-time exit alerts via text and email, as well as a weekly kind of market commentary, understanding how a professional trader trades the trending stocks within the NASDAQ 100 using options.
All right, great. And this course is going to, and the reason you guys want to get started right now, get that, get that pre-course educational material, because the course is going to start November 14th, and you're going to be on a Tuesday and a Thursday, each 1 hour session, correct?
Yeah. So just getting a little bit extra time with the book and to prepare yourself with, if you have any questions, I think is important here. So the sooner you start, the more you can get ahead of the game before the actual course begins on November 14th.
And, we talked about, we pushed you, I know, on this, but we want to do something even better. All right. So for the first 5 people that call, and I'll give you the number in a second to call. For the first 5 people that call, we're going to knock another, Keith, $500 off.
$500, yeah. So
right?
no, I think, I mean,
I know you weren't expecting
great value.
But we want to get people started, because they've got the pre-course stuff to go through before they get to the weekly sessions. So we're talking taking 500 off the $29.97. So that's going to be $24.97, but you got to be one of the first 5 callers. I'll put up the numbers here. It's 800-883-0524. If you're outside the US, it's 737-292-4425. Or you can email us at support@ffrtrading.com. I'll leave those numbers up. So Keith, again, just maybe take us through a little bit of why this is important. Now, of all the traders that I've known, your educational background coupled with your experience, you're obviously somebody that any trader would love to learn from. But maybe break down why learning from you is going to be very important for those that are out there that are kind of on the fence. What is the difference getting an education from you versus somebody else on the internet?
No, absolutely. I've culminated my knowledge here in over 15 years now with trading with, as I mentioned, market making firms, proprietary trading, hedge funds. Basically, I've run the whole gambit. I've seen the strategies that everybody tends to use as market participants. I've understood how to combine options trading with technical trading, which isn't always the case. Some people are really good with technicals, others are really good with options. I try to bring in both here, and that gives a little bit of an advantage over a lot of other people, because you've got now my experience with many different sides of the market, as well as the two key elements to my market trading, which were the technicals and the options analysis. And I take a very analytical approach to all of it, which I think is very important in technical trading, as I mentioned, with being a math major and the analytical background at Chicago Booth. I think that I bring something different to the table than a lot of people.
And just some things to think about, guys, as we're talking here, is you're here for a reason, right? You're looking for a way to generate monthly income, or you're looking to build a retirement for yourself. Earning a few percent in a mutual fund, right, is not going to cut it. You need to do something different, okay? And maybe you're looking for a trusted source where you can learn to trade and earn income while you're learning. Maybe you don't have the time to do that yourself or the expertise, and you're looking for help. Would this help? Okay. Keith is committed to helping traders like you achieve mastery in options trading. And that's why we're trying to empower you. Like I said, if we go back again, just to pull up the offer here. Again, if you're one of the first 5 callers, you're not going to pay the $29.97. Okay, you're going to pay the $24.97. We're knocking another $500 off, but you got to be one of the first 5 to call. And the bonuses we talked about, the free one-on-one session, the 1 hour one-on-one session with Keith, post-course, the pre-course educational material, the book, Think Like a Market Maker, Profit Like a Pro. Again, you want to get started as soon as possible, because again, those classes are going to start November 14th on Tuesdays and Thursdays, an hour each time. It will be recorded. And for those that call today only, you'll get 90 days or 3 months of the Big League Options weekly alerts. Right? So the only way you can change your future, right? If you've been somebody on the fence, you've been wanting to learn options, the only way is going to take that step. So I'm just asking you, take that step, okay? Call us at 800-883-0524. Again, outside the US, you can use that 737-292-4425 number, or support@ffrtrading.com. All right, guys, we'll get ready to wrap up. Keith, any last thoughts? If anybody's on the fence, what do you have to say to them?
Well, I think obviously we're looking at trying to give you a lot of value here, especially if you sign up today. The people that sign up today, the reason that that they were able to convince me to take that extra $500 off is because I know, excuse me, anybody that signs up today is particularly excited about changing their trading or improving their trading. And those are the people I'm most excited to work with. So, if you're on the fence and you're thinking about it, you can make the change today and start, or you can wait 6 months and say, gosh, now I'll make the call and change now after taking a lot of learning lessons from the marketplace. Better to take the learning lessons from somebody that's been there for, I guess it's now, 17, 18 years. So.
All right, fantastic. So we've got people calling in already. Guys, 5 spots. If you want that extra $500 discount and all the bonuses that we talked about, call us now. Keith, it's great getting to meet you. Again, totally impressive background. I hope the folks realize what they're getting here and the value that you're offering here. Again, those sessions will start November 14th, so call now so you can get started on that pre-work material before the class starts. And if you have any further questions, again, just email us, support@ffrtrading.com, and we'll go ahead and wrap up here. Keith, again, a pleasure, great working with you, and I look forward to doing more events like this with you in the future.
Absolutely. Thanks for hosting me, John, and FFR.
All right, everybody have a great rest of your trading week. All right, manage your risk, and we'll see you back in the next event. Take care.